The thing they don't realize is that the dollar is just like the best house in an awful neighborhood. Mm-hmm. They're all getting debased, all of them. So the US dollar is getting debased less than the other currencies. So your measuring stick of these other currencies shouldn't be another currency that's depreciating. You have to measure all assets, whether they be the dollar, houses. You need to measure them against something that isn't moving.
This is the Blue Collar Bitcoin Podcast, a show where average Joe firefighters explore the most important monetary technology of the 21st century. We talk Bitcoin, we talk finance, and we talk shit. Folks, we are glad to have you back for yet another intellectual adventure here on the Blue Collar Bitcoin Podcast. My goodness, do we have an absolute banger for you this week, as Josh and myself, Dan, are joined by the incredibly insightful Mr. Ryan Deedy. Ryan is a chartered financial analyst who spent the last 14 years working as an equity analyst in the investment management industry. He most recently worked at hedge fund Millennium Management, where he conducted fundamental research on the aerospace, defense, and transportation sectors. Prior to Millennium, he worked at RiverSource Investments, Manulife Investments, and Putnam Investments, where his research included the financial, technology, telecom, industrial, and consumer sectors. Over the years, Ryan has grown to believe that many of today's societal and economic issues are due to a broken monetary system, and that the innovation of Bitcoin is a solution to most of them. In this conversation, the three of us go both wide and deep across topics including a summation of the last 100 years of economic history, the risks of ignoring Bitcoin, how technologies grow exponentially on application layers, zoomed-in dollar strengthening and zoomed-out dollar devaluation, liposuction and the cure to fat butt disease, and the real bait of the episode, Ryan's jaw-dropping Bitcoin price prediction. We highly encourage you to follow Ryan on Twitter at Ryan_Deedy. That's at RYAN_DEEDY. As always, you can follow us on Twitter at blue_collarbtc. And if you are a regular listener and a fan of the show, you can legitimately assist our reach by leaving a review and or subscribing via your app of choice. We have some stellar sponsors of the BCB podcast, COINKITE and LEDN, and details about both these Bitcoin-focused companies are down in the show notes. LEDN is a very unique financial services company with a highly principled Bitcoin-forward perspective. LEDN is the first ever digital asset lending platform to undergo a formal proof of reserves attestation, where an independent public accountant regularly attests that the company is properly accounting for client assets. To put this plainly, this company mirrors and embraces the transparency, accountability, and auditability of the Bitcoin protocol and network itself. If you've listened to this show much at all, you certainly notice that we advise our listeners to be careful, manage risk, and never get over-leveraged. And that does include ensuring that any borrowing and lending decisions make sound mathematical sense based on your lifestyle and your specific situation. Where available in your jurisdiction, LEDN offers a menu of powerful financial services. Keep ownership of your Bitcoin and access dollar loans with LEDN Bitcoin-backed loans. Harness your Bitcoin holdings to buy a new property or finance the home you already own with the upcoming LEDN Bitcoin mortgage product. Save Bitcoin and USDC to have access to LEDN dollar loans in their trading service if available. You can look into all LEDN's well-architected menu of services at ledn.io. That's LEDN.io. And of course, BCB Podcast is also powered by COINKITE, makers of the Cold Card, the Open Dime, the Block Clock, and a plethora of other Bitcoin pleb-worthy hardware and merchandise. If you're interested in having more peace of mind than a Buddhist monk with your Bitcoin secured behind military-grade Bitcoin security hardware fit for generational storage and protection, look no further. The two of us used this device long before this partnership, and we can attest it's fit for the Bitcoin cold storage newbie all the way up to sophisticated users. If you're someone that needs help with cold storage or doesn't even know what cold storage means, shoot us a DM. We're glad to steer you in the right direction. We also have cold card guides down in the show notes. You can access all COINKITE products, including the brand new Cold Card Mark IV at COINKITE.com, and be sure to use promo code BCB for 5% off cold card purchases. All right, now prepare to chew on the meat of this bone as we pick the brain of Ryan Deedy. All views and language expressed by the hosts and guests in this podcast are solely their personal opinions and do not reflect their employers or organizations they are associated with. Do not treat any of the content in this podcast as investment advice or as an inducement to follow a particular strategy. This podcast is for entertainment purposes only. Ryan, welcome on the Blue Collar Bitcoin podcast. This is awkward because we just had some technical difficulties, so we cracked a joke in the beginning. Can we crack it again, Josh?
Maybe we'll reattempt.
I want to hear it again.
I was gonna full disclosure here. I had a rough night last night. I'm feeling good now, but man, it took a lot of water to get back from zero this morning. We had a black shift poker night last night, and it was a rough affair. People aren't proud of what they did last night. I can tell you that.
Only the utmost professionalism at our department, Ryan. Ryan, how are you today? Thanks for giving us the time.
I'm doing pretty well. I kind of wish I was invited to that game last night. I haven't played poker in a while.
It was a big ante. It was $10 to get in. I don't know if you would have been able to swing it, but yeah.
I'm more of like a $5 guy. $5 all in tournament style. You do it more regularly.
Yeah.
First names only, Josh. Who's the punching bag at these things? Like, who gets taken for all they're worth?
Ooh. I think I'm actually on the top of that list. I'm a terrible poker player. I was playing. I mean, I played maybe like 6, 7, 8 hands, and like I'm just not I don't want to sit in this game. I just want to go hang out and bullshit. So I kind of went all in and just punched out.
Is that alcohol related or intelligence related? Your inaptitude in these games?
No, that was like one beer in. I'm just not into poker. Poker gambling, it's not my thing.
Josh's just not that intelligent.
Yeah, definitely not. I just can't count the cards. It really bothers me. Just got to punch out. When you don't have an advantage, you just punch out.
Yeah, I hear you. Cost of admission.
Ryan, tell us about your background. Introduce yourself to our audience.
Ryan Deedy, born and raised in Boston, Mass. Spent about my background from like a work perspective. Spent the last 14 years working in the asset management industry in Boston as an equity analyst. So, just the way to think about it is, in terms of the job, you have portfolio managers and then you have analysts. Each analyst is assigned a sector to research with the ultimate goal to determine which stocks within that sector the funds should buy. So I spent the last 14 years in the industry, saw a lot of interesting things. I entered the industry in 2008. Not the best timing. 6 months later, I was living through the global financial crisis and proceeded to lose my job at the end of the year. Our whole fund shut down.
Ouch.
Fortunately, it was just a couple months later, I joined another firm, Putnam Investments, also based out of Boston. Stayed there for 8 years. And that's where more or less I learned everything in terms of the job. So the first few years was on the US team, but then moved over to the international team for the last 5 years. Very interesting experience there. Spent half of my time living in Boston and the other 50% of my time living in Singapore. I was covering a lot of, obviously, international companies, but a lot of companies based in Asia. So, made sense to live over there. So I was there until the end of 2016, made the move to Manulife Asset Management, also based in Boston in 2017. Was also on a global team, similar job, but was covering more sectors. But again, similarly, from a geographical perspective, looking at companies all over the world. Was there for about 3 years. And then my most recent job was I joined Millennium, which is a hedge fund based out of New York at the beginning of 2020. And I was there for about a year and a half up until the end of last year when I resigned to spend more time in Bitcoin.
What was it that fell over to knock you into Bitcoin? What year roughly did you get in, and what was the first mover to push you into the space?
The real catalyst was, I had heard about it as everyone had at one point in their life, prior to 2017. We'd all read about the Winklevoss twins, putting their Facebook proceeds into Bitcoin. It all sounded crazy to me.
Geniuses.
And geniuses in hindsight.
Yeah, turns out.
And I guess given my background, being in asset management, looking up to like the Warren Buffetts. I'm a value investor, looking up to Warren Buffett's, hearing, everything that there's no value here, et cetera. I just more or less ignored it. But then my wife went to business school, and she went to MIT in Boston. And I didn't go to business school, but when I think about business school, you go to business school to, meet a lot of people, make a lot of connections, really, and you really just want to dive into the business school bubble to maximize your experience. So with that in mind, I suggested that we move to MIT. And MIT is 3/4 of a mile from where we were living in Boston, but I just thought it made the most sense to live on campus. So we moved over to MIT. We shared a parking lot with the business school. It was really funny. We were in graduate housing. We were probably the only ones there living there from Massachusetts. Everyone else was, families or international students. But at the end of the day, it was the right move because she was able to just always be involved in the community. But right when I got there, it was all about Bitcoin. It was all about crypto, blockchain. You just couldn't ignore it. Yeah. So everyone seemed to be working on a blockchain related project, or if they weren't working on one, they desired to work on one. So it just made me think, number one, am I missing something here? These are obviously very smart people. So it more or less just made me finally take the time and to look into it a little bit more. And there were plenty of resources there that I could engage with if I had questions or just wanted to interact with others. So it was at that point where I really started doing my own research and I had already had a really good understanding of the existing financial system and how it worked. And I knew there was, it obviously wasn't a perfect system. And I was able to see pretty early on the innovation that Bitcoin was and see where it could fit in. But at the same time, it was unclear in terms of what that catalyst would be in order to actually get adoption of this. Mm-hmm. Because Bitcoin, it can be this perfect monetary asset, but if you don't have a network, you don't get the value out of it. So that's more or less where it kind of started. And then, going on through, that was mid 2017. So, I think we all saw the run up in 17, the crash in 2018. That really helped people separate Bitcoin from the rest of everything else.
Sure did.
And then, just learning from that point forward, I was always a really big fan of Ray Dalio as well. So I was able to, mesh those two, and it all made a lot of sense to me. And then it finally, again, I didn't understand, or I wasn't quite sure what that point would be where adoption, that would catalyze adoption. And then March 2020 came. Seeing the reaction of the Fed and the US government it was very evident that they didn't know what they were doing. And based on all of my study of economic history, when you intervene in such a fashion, it will result in a significant devaluation of the US dollar and, more or less cause people to want to seek a better store of value. So, that was the alarm for me. And it was at that point, soon thereafter, I felt it was very important to spend a lot more time speaking with friends and family about this asset. Full disclosure, prior, I've been investing my whole life, but I very rarely provided financial advice or guidance to family members or friends because there typically is never any upside to doing it. I was always there to answer questions, but never to proactively discuss this with someone. But when that happened, and I saw the impact that the Fed and the government's decisions had on friends and families, savings, et cetera, I thought it was extremely important to be proactive and teach as many people as possible about the importance of this. So from that point forward, to this day, I've been spending between 10 and 20 hours a week speaking with people. And as you know, it takes a long time, and I'm not here to tell anyone what this is. I'm just here to help answer questions and guide people down the rabbit hole and point them in the right direction so they can fully understand it themselves.
There is a precariousness, though, with sharing this. I mean, especially we're talking at a time when Bitcoin's way down. And I'm sure all three of us have these people in our life that are newer to the space that you're kind of hand-holding through this process. And there is an element when we do have these cutoffs where you do realize that people need to lead themselves to water. You can't push them. They have to do their own homework and their own research to be able to keep their hands around this thing in an environment like we're currently experiencing. Mm-hmm. I agree, though. My mouth has been largely shut through my life on my financial decisions with friends and family, but this asset is so pristine, it's nearly impossible to do that. And your conscience almost steps in and says, like, you need to share the significance of this.
Yeah, I thought it was like a moral obligation to do it.
Yeah.
And because of that, people were very receptive because it was the first time that like myself or going into friends and family to talk about this. So they immediately paid attention, and it's don't trust, verify. But there wasn't an immediate dismissal because there was some element of trust in me personally that they would give some time and read a couple of books before they dismiss it. So I always approached the conversation where you have to have an open mind. If you don't have an open mind, then it's just not worth your time. It's not worth either of our times. If you're willing to have an open mind, and I would present to them the amount of work that I've done and how important I think this is, then I think typically, for the most part, they were very receptive. And then I was always available to answer questions. And there was there's always been a lot of engagement. So there has been zero like forcing this data, pinging someone over and over again. Like you have to look at this again. I mean, it's not my role to tell them where they should put their money or what they should spend their time doing.
Ryan, you've created a piece, you call it Bitcoin due diligence. And for people listening, it's basically a synopsis for people that are being introduced to Bitcoin from an institutional vantage point. And Ryan's done an incredible job. If anyone listening wants to present this to somebody who's got that more institutional background, this is an incredible way to do it.
Is this even available, Ryan, or is this top secret locked up material?
That's a good question.
No, it's I've shared elements of it. I mean, it's not top secret. Again, trying to help as much as I can.
I thought we were special for a second, Josh. It's kind of a bummer. Crap.
Well, I mean, put it this way: it's not many people have it. Because what I wanted to do is I wanted to write some articles about it to elaborate on some of the points. Because for some people, it's extremely helpful because they already have a good solid baseline.
Yeah.
Or for other people, it may not make any sense.
Right. So.
We'll put it behind a paywall. We'll take 20%. We'll send Ryan the other 80%.
Wonderful. Perfect. This thing's a masterpiece, though. This thing is phenomenally well done.
One of I think for me, reading through this thing, and I want to talk about this a bit, Ryan, the thing that really strikes me as like the masterful way you've set this up is you kind of walked through each one of these economic paradigm shifts that we've been engaged in the last 100 years. Starting with the Great Depression, World War II, the Nixon shock, the 70s inflation, the Great Financial Crisis, and finally COVID and what we're seeing now. If we could, maybe briefly, could you walk us through this entire paradigm shift from the Great Depression till now, and like how these paradigms have changed, waxed and waned over time, and like how that affects your outlook as far as how you're going to deploy your money? I know it's a big question. That's a lot of stuff to go through.
Yeah, it's a big question. I'll try to tackle it. So I think just first off, this all comes back to the Fed. The Fed plays a big role in terms of how our economy acts. So if you look at the mandate of the Fed, the Fed's job is to use its policies to maximize employment and maintain stable prices. Now, in order to do this, they have these traditional tools, so like open market operations, buying and selling of treasuries, the discount rate, reserve requirement. The goal is to make sure the economy doesn't get too hot or too cold. Now, in my opinion, I think they've done a very poor job. I mean, over the last 100 years, we've had about 15 recessions. And then in the piece that I did, I wanted to look at those 15 recessions, then narrow down and zoom in on a subset of 5 of them, where things got so bad that the Fed had to throw out its old playbook and introduce an entirely new monetary policy framework. Now, across each of those 5 instances, there was a key similarity. And it was that debt levels had reached an unsustainable level, which was the catalyst for the Fed's change of course. There's no way to reduce the country's debt burden, so debt to GDP, or at this point, there was no way to reduce the debt to GDP without resorting to something more extreme. So if you think about like leverage, debt to GDP, how do you drive it lower? If GDP is no longer growing the denominator, then the only way to reduce it is by reducing the amount of debt. And then once you reduce the amount of debt, it gives you more wiggle room to, stimulate the economy, print money.
Right.
Of these 5 instances, you had 1933, 45, 71, 79, successful. 2008, they failed. So just answering your question, just going back through each one of these. So Great Depression occurred from 1929 to 1939. It followed the 1920s, the roaring 20s. The stock market was roaring. People felt good, taking out a lot of debt, borrowed money against their homes to buy stock. October 1929 comes around, stock market crashes. That had ripple effects across the system. There was a complete loss of confidence. There were bank runs, bank failures. GDP declined. As a result, debt to GDP increased significantly. So in that situation where the economy is stalled, the only thing you can resort to is by reducing the debt. So President Roosevelt at that time effectively abandoned the gold standard. He suspended the convertibility of the dollar to gold. And then in addition to that, he issued Executive Order 6102. So that criminalized gold ownership, and it forced all of the public to sell its holdings. Once they had accumulated all that gold, they subsequently devalued the US dollar by 40%. So if you think about 1933, $1 would buy you almost 5% of an ounce of gold. Fast forward a year, it would only buy you 3% of an ounce of gold. So boom, very quickly, the value of the dollar declined and the debt burden of the US government was now lower. So at that point, it allowed them to introduce more stimulative policies that we essentially saw over the next 10 years. So you saw, the money supply increase double digits. So that was the first time they really went into this, executing out of a completely different playbook. The second time was you fast forward to the end of World War II. So throughout the 40s, the U.S. government's deficit was growing to fund the war. Saw rapid growth in both the money supply and subsequent inflation. Fortunately for the U.S. in this situation, despite having all this debt, because they were in a better relative position versus other countries, when there was the gathering of the 44 nations up in Bretton Woods to establish the Bretton Woods monetary system, the US dollar was made the global reserve currency. So the US was more or less able to escape from those debt burdens that they had built up throughout the war. But at the end of the day, the value of the US dollar declined for anyone that was holding it. So that was number 2. The third instance was in 1971. So there was a lot of economic stability between, the end of World War II and the 1960s. But throughout the 1960s, government spending started to really pick up again. It was to fund, there were a number of domestic social programs that were funding the Vietnam War. And again, like previous times, you started to see the debt level of the US grow, and it eventually reached unsustainable levels, where it was at a point where the foreigners, because we were on the gold standard back then, the foreigners were demanding their gold.
The French actually sent a battleship over to collect their gold, didn't they?
They did. They went to, they're outside of New York, and they were requesting their gold from Fort Knox. And that's what prompted Richard Nixon in August 1971 to close the gold window. Essentially, they had more credit issued on top of the gold than they could meet. So when they discontinued the US dollar gold convertibility, again, it was a default on the promise. And by removing the dollar from its peg to gold, it resulted in another devaluation of the dollar. So when you have a devaluation of the dollar, that again reduces the debts of the US. So in all those three situations, you saw the debt burden of the US decline to improve their debt to GDP. And it was all because of these extreme measures. So that leads you to the fourth instance. It was in the 1970s. So, this was after they went on a pure fiat monetary system with no gold backing. Because of that, you could introduce whatever stimulative policy you'd like. And you quickly saw the debt burden grow, inflation rise. And it was a little bit different this time. So you fast forward to the end of the decade, and Paul Volcker was the chair of the Fed. And he chose to take a different route. So instead of defaulting on the obligations, he actually changed the way they were going to manage monetary policy. And so more or less what happened was his change in policy resulted in the federal funds rate increasing from about 10% to 20%. So when that happens, it quickly washes out anyone in the system that has taken on too much risk. And that was the way they were able to flush the system of the excessive debt. But there was also pain in this process. You saw there were two subsequent recessions in the following 3 years.
And debt loads were low, especially relative today, extremely low.
Yes, pretty much at every point in history relative today, they were far lower. So just for perspective, when that happened, if you look at public debt to GDP, it was around 30%. Today, we currently stand at 120%. So it was a situation where by increasing the interest rate that much, it wouldn't have been too much of a burden on the U.S. from the government, right, where they'd still be able to operate. Although it did pull a lot of liquidity out of the system, which resulted in the overall debt load declining. That brings us to the 2000s. So we all know in the 2000s, interest rates were very low. There were very easy lending practices, the subprime loans, adjustable rate mortgages, eventually led to a housing bubble. And the Fed tried to use its normal tools, but when it started increasing rates, because housing was the core of this growth, when they started increasing rates, you started to see home prices decline. And that triggered a financial and liquidity crisis. So in order to increase the liquidity in the system, this is where the Fed first introduced quantitative easing. It was purely to increase the liquidity within the system, with the hope that it would also drive, economic growth. So over time, the overall debt burden, debt to GDP, would go down. So November 2018 comes around, they pump $1.4 trillion into the banks over the following 18 months. They buy up, most of it at that time was the mortgage-backed securities, and there was a bit of US treasuries as well. Stabilized the banking system for a little while, but the debt burden continued to increase. So the economy really wasn't budging. So you fast forward another 6 months, they had to step in again. They pumped another $600 billion into the market. Nothing happened. Debt burden continues to grow. Mm-hmm. You fast forward another year, economy remains weak, pumped another $1.7 trillion into the market. Nothing happens. Debts continue to grow.
Right.
Nothing. When I say nothing happens, I'm talking about from the economy perspective.
Right. GDP wise.
This whole time, the stock market is pumping.
Right. So just a quick question in there. So the idea from the Fed's perspective is we inject this money. We're hoping against hope that the GDP number is going to move and increase, at least in parity. That way we don't see, any ill effects from this. That's at least the position that they're taking, right?
Exactly.
Okay.
Exactly. From the economy's perspective, though, all of this increased liquidity into the market was not having the intended consequence. So if you remember, they often talked about we still haven't reached the 2% inflation that we were trying to achieve. So that allowed them to justify pumping more money into the system. The economy started to somewhat improve 2015, and then they stopped. They stopped for a while. And then you fast forward, I'm going to get the month wrong, I think it was early 2018, and they started pulling back, removing stimulus from the economy. But then you fast forward a year and a half later, and September 2019 comes around, and liquidity just dries up. So you see the repo rate spike, and they have to enter in again, pump another, it's like just over $500 billion into the system, pretty much reversing everything that they had previously taken out in order to, maintain the to stabilize the market. So throughout that whole period of time, you just fast forward, and this is all before COVID. Every bit of quantitative easing that they had, or any new dollars they put into the system, only resulted in a worsening, debt situation. We had talked about like 1979, the debt to GDP was 30% when Volcker increased interest rates. Entering into the first time they did QE, that ratio went from 30 to about 70. And then you fast forward to COVID, and it was even higher. So that brings us to COVID, which was 6 months after they had just pumped in another $500 billion into the economy. Now, we all know what happened with COVID. They completely shut down the economy, and then they put in, over the course of the next year and a half, they added another $4.5 trillion. So, they didn't think that this was going to cause any inflation because it didn't happen in QE1, QE2, QE3. But when you force everyone to stay home, then give them a bunch of money, so supply of everything goes down, demand for everything stays the same, that should result in higher prices, which is what happened. And that kind more or less leads us to where we are now. So now we are sitting at a debt to GDP of close to 120%. We're seeing inflation, and there's very little that the Federal Reserve can currently do, or I guess they're in a predicament. It's
crash the economy, I guess. That's what they're going to do. It's crazy.
As I hear you talk through this arc, Ryan, what it makes me think about is what makes 08 and today different than the previous installments. And although we never returned to truly hard money, when you trend 33 post-World War II, there was some semblance of an attempt to turn back to hard money in some way, shape, or form. Post 71, there's really nothing at the base layer now. You think about what Volcker did. He actually did face the music.
He did.
If you think about how he managed the situation. In 08, we didn't face the music because we don't have to, right? Which goes back to the architecture of the system, which is fiat. But it's like, if you had fat butt disease 150 years ago, there was only one cure. You had to stop eating and start exercising. Now we have liposuction. You can kind of kick the can down the road, change no habits, and at least outwardly thwart your fat butt disease.
Yeah.
Our move off the gold standard is basically monetary liposuction, Josh, and it's not a permanent solution.
Just to interject here for a second, or you could do a lap band. And Dan and I had a chief like 6 years ago that got a lap band. He ate his way through a lap band and continued to grow. Like, impressive stuff. The lap band didn't even work for this guy. He QE'd his way right through a lap band and just printed himself another 40 pounds.
Jeez.
Ryan, do you kind of agree with the way I characterize that, though? Like, we can keep kicking the can down the road because of this new flimsy architecture.
Yes, you can, but I think there's a point. It's to a point.
Right.
And I think there's a reason why we got to where we are right now. I think there's been just a general misunderstanding from the Federal Reserve's perspective. And I think this has to come down to how you think about economics in general and whether you should be intervening or not. And this is where it really dawned on me. When 2008 happened and they had to pump money into the system, that was a liquidity crisis within the banking sector.
Mm-hmm.
Right.
So more or less what they did was, you have this, if you look at your liquid assets of a bank, you may keep some of that in cash, you may keep some of that in treasuries, and And I think about like those two combined is total liquidity. When they first implemented QE, all they were doing was injecting cash into the banks and exchanging those for treasuries. So now these banks have a ton of cash, it was a liquidity issue. So that was like a lesson learned, and you had new regulations that went into place where all the banks had to have higher capital ratios, and so you didn't have to worry about these liquidity issues. So you fast forward to 2020, and the banks have zero liquidity issues.
Right.
Like, so for context, that I'd said before, roughly 15% of their assets were in liquid assets. I mean, going into March 2020, that had increased to 30%.
Totally different. Totally
different. So I guess the point is, the first time the money went directly into the banks, it didn't go to the consumer.
Far less inflationary.
Right. You're not going to see in consumer prices.
Right.
Whereas this time, the money went right to the consumer.
I think so many people were very confused about this, because I do remember I paid some attention to financial markets back in 2008 and 9. Everybody thought after the injection of liquidity back then that this was going to be inflationary. A lot of, at least a good subset of people did. And then when it didn't happen, everyone was kind of like scratching their head, because I don't think most people quite understood the mechanics of how QE actually worked. To be honest, I think I barely grasp it now, but basically the money never really entered the system. It just sat in the banks, right? But now this is completely different. They literally helicopter money directly to consumers, who then went straight to the store and bought a Peloton that they don't use anymore.
Josh,
that's inflationary, obviously. No, I sold it.
Ryan, this is such an important distinction for our listeners. QE1 and QE4 totally different.
Right, but the point I'm trying to make though is that everybody that saw that happen in 2010 is thinking now, or at least a couple of years ago, going, well, last time this wasn't inflationary, so why would it be inflationary now? But the misconception is just misunderstanding of how this money was injected, and obviously that makes a huge difference.
Yes.
We're seeing it now.
Yeah, this is a huge deal. You have to trend which way this is going. So as you just said, Ryan, QE1 is basically a bank recapitalization exercise.
Yep.
But QE4 is smelling and looking a lot like debt monetization, right?
Exactly.
They're very, very different mechanically. Walk us through that dynamic of QE4 that we just saw through COVID, and then I'm assuming you see that trend continuing. Explore that dynamic.
Yeah. So maybe just going back just to the way to hopefully quantify the impact, or not quantify the impact, but point to some proof, is if you look at, between 1980 and 2020, if you look at the M2 money supply, it grew on average at 6%. All right. And it more or less, the range was as low as 0% to low teens. And that's consistent through 08, 09. So, I mean, M2 is the way it's more or less the money that's out in the broader system, right? It's including people's deposits, savings account, checking accounts, etc. Currency in circulation. So you didn't see a huge increase during that period of time. Meanwhile, if you fast forward to QE4, we have seen over the last 2 years, we've seen a 43% increase in the M2 money supply. Now, that's cumulative. So if you were to look at right now versus March 2020. But if you just look on a year over year basis, because that's what I was making the previous comparison to, where it was averaging 6% over time, on a year over year basis, at one point last year, it was up 28%, right? So that's money actually floating around in the system. So fast forwarding to where we are now, it's a really interesting environment, because if you want to maintain the economy, an economy that is, if you think about what the Fed has been doing, they've constantly been providing people dollars to spend. I mean, if you give me $100 every single year, I'll spend it, and that'll go into GDP. If you want to give me 100 now, 110 next year, 120 the next year, I'll keep on spending it. We'll grow our economy, right? Right now, they're pulling back. So those checks, the amount of money in the system is getting pulled back at the margin. The issue is by doing this, it also has, and by increasing rates, it also has an impact on the stock market. It has an impact on broader asset prices. So all of a sudden, my net worth was $100 yesterday. It's $80 today. I feel a lot worse off. So I want to save a little bit more. I don't want to go out and spend. I don't want to buy the wife dinner, etc. Mm-hmm. So all of a sudden, that has a negative impact on potential GDP, right? And if you need to grow GDP, you need to grow GDP above the rate that debt grows. Yep. Then now you're in an interesting predicament, because the government, over the last 50 years, the government, we've always had a fiscal deficit. So in the last 50 years, I think we've made money, we've profited, been in a surplus for like 5 years. Okay, something very small. And because of that, you have to borrow the difference, right? Like if I spend $100 every single year and my income is $50, then I just have to keep on borrowing that incremental $50 until someone will stop lending me money. So that's what the U.S. that's what they've had to do over the last, since 1971. Yeah. But there's always been a lender. There's always been a lender. The issue that they're facing right now is, if you look at prior to COVID, so if you look at from the beginning of 2002 until through 2019, and you look at all of the debt that was being issued by the U.S. in terms of who the buyers of that debt were, roughly 85% of that was being bought by institutions or people domestically or internationally. Now, over the last 2 years, that declined to about 40%.
Yeah.
So if foreigners and people domestically don't want to buy it, then who has to fill the void? That's where the Federal Reserve comes in and buys up the debt. So therefore, that is, and by doing that, think about it, you're giving the government more money, and then that money is being spent on the economy. So that's also inflationary. Right. That's not going into the banking system, that's going around the banking system, because it allows the government to continue to run a budget deficit.
Before you go too much further, just a quick thing to interject. So it seems to me like so obviously QE, or injecting money, they're hoping to grow GDP. It seems like it's becoming less and less sensitive with the increasing amount of money. So their upper bound is less sensitive to the money injection, and their lower bound, when they withdraw, seems to be more sensitive. So this is becoming a more unstable system in perpetuity, which I think is what the point of this talk. But just to drill that down and so people understand it, you're getting less sensitivity to the upside and much more sensitivity to the downside when the liquidity is withdrawn. It's a big problem for them. The other thing you mentioned, I think you said 40% of the treasuries are being bought by institutions and all that. Now they have something to the tune of $9 trillion to roll over in the next few years, which is interesting considering how do you see that playing out?
Taking it apart, so two different ways to think about it. You have the rolling of existing debt, and then the issuance of new debt on top of that. So 9 trillion now, it's been growing at 7% per year over the last 3 decades. So if your debt burden is growing, let's just say at 5% to make the numbers easy, and your GDP is 3%, then the situation gets worse.
Right, so and your interest rates are going up.
Right, and then if you're going to increase interest rates as that debt rolls over, you're also going to be paying a higher rate on a larger number. At the same time, it also comes at a time when there has been less demand for U.S. debt from every party, from foreigners and those domestically. So if you look at again, just to kind of take a step back and put it in context, if you go back to 2014 and you look at all of the outstanding U.S. government debt, roughly 35% of that was held by foreigners. Numbers just came out yesterday, the day before, but that's now down to 25%.
Damn, that's a huge change.
So you've seen a huge shift, and there's just been a diversification away into other assets. So, for example, you're seeing this in the news just with earlier this year with Russia. If you look at Russia, for example, they have their they have their reserve account, and if you go back to 2014, 3% of their reserves were in gold. Now it's 21%. You've seen. I mean, that's a more extreme example, but also very topical given the times. But it's also consistent with a lot of other countries. For the most part, the absolute dollar amount of debt held by foreigners has been little changed. So I think it's gone from about $6 trillion, 8 years ago to like 7 now. Like that's nothing. So again, who's going to fill that void? Either people domestically or who are also showing less of a desire, or it's the Federal Reserve steps in, which is what's been happening.
Yeah. Our pension fund's going to belly up to that trough.
Yeah. So we've covered some of these topics already. In your piece, you highlight sort of this triple threat of macro fuckery right now, which is you've got highest ever debt over GDP with, we just covered fewer consumers of the debt, more than likely, lowest ever or close to lowest ever Fed funds rate, at least when you compare the cycles as they trend down, nearing highest ever inflation. And the last time inflation numbers were remotely close to this, the debt environment was totally dissimilar.
Yep.
This is not a drill. This is very different than previous situations. What's your take on that triple threat of macro fuckery? And then what are you like as they engage in this process of tightening and tapering? I mean, they're supposed to start June 1st here, unwinding the balance sheet to some extent. Where are we? How do you see this going the next couple of years as they try to ping pong against these two walls and handle many, many fires at once?
Very tough question. I wish I knew the answer. My take on it has been that, I guess the conclusion is I don't think there's a way out. Like if I was if I was Powell in that seat, I don't think there is a viable solution to either taper and pull back the amount of liquidity. So you have a soft landing, and then you accelerate, or a softish landing. I mean, I never want to have a softish landing.
Maybe we've got it all wrong. I don't know if you guys saw they've been putting fences up around the New York Fed. Maybe they're putting suicide nets around it too.
Make the landing softish.
So it's really concerning. I don't think that there's a way out. I think what's going to happen is they know that if they continue to support the economy, you're going to see a continuation of what we've seen over the last decade. You'll see inflation rise. You'll see asset prices go straight up into the right. And again, it's just kicking the can down the road. At some point, the value of the dollar depreciates to the point where, like, the prices right now that you're seeing, I don't think are real. You can view everything through two different lenses. One is that, like, houses are going up in value, or the value of your dollar to buy those houses
is going down.
That's the way I view it. And that's purely because, it makes sense when you think about, like, the money supply, the amount of money that's chasing goods.
It's also kind of interesting. You watch the DXY right now going up and up and up, while at the same time we're watching prices of fuel go up and up. And like it's kind of counterintuitive. It doesn't make a lot of sense unless you understand that the DXY is kind of a measure of other currencies also devaluating. And we're watching the dollar devaluate against real goods in real time while appreciate against financial assets. It's kind of a strange situation.
So I think I get this a lot, especially from people with my background, which I think is kind of crazy to me. Although it wasn't intuitive to me right away either. But first of all, DXY, it's a basket of currencies. Like the euro, the yen are the two largest components. And because those two currencies have been depreciating versus the US dollar, that's what's driving the DXY higher. But regardless, the pushback I'll get sometimes is the dollar is fine. It's strong versus all these other currencies, or it's been stable versus all these currencies. The thing they don't realize is that the dollar is just like the best house in an awful neighborhood. They're all getting debased, all of them. So the US dollar is getting debased less than the other currencies. So your measuring stick of these other currencies shouldn't be another currency that's depreciating. You have to measure all assets, whether they be like the dollar, houses. You need to measure them against something that isn't moving. And that's why I think historically, gold has been used as a has been used as like the base layer of our monetary system because you can't just create more of it. You can't inflate it. And this is also where I think like Bitcoin comes in. So a lot of friends, would say to me, my house went up, doubled over the last 3 years from 300 to 400, 500 to 600,000. And I would say, I don't know if your house went up. Like your house can go up for two reasons. If you bought a house for $300,000 in an awful neighborhood, and then you foresaw a ton of demand for that area, you had a flock of buyers, you sold it for $600,000. Like that's supply demand. Like good on you. That was a phenomenal investment. The other way, you can also see your asset go from $300,000 to $600,000 is the amount of dollars in the system going up. So that currency being debased. So you need to use more of a worse currency to buy the same house.
And coincidentally, like you said, M2 was up 28% last year. Guess what? The average home price was up last year.
Yep, exactly.
Damn near the same percentage.
Yep, exactly. So I think that's really what's going on here. And I think it's important to put that into context. But I think it brings up another interesting point where if you think about like based on my own historical experience in asset management, it depends what kind of investing you're doing, but you may have like a mutual fund or you have a hedge fund. So you may have different strategies. But if you're a mutual fund and your performance, so there are more or less like two fees that you're charging, or there are two ways to compensate. Number one, you're paying an investment manager, say 1% or less to manage your money. Okay, so that's how the firm is getting paid. But from the portfolio manager or the analyst, you're getting paid based on performance. And it's relative performance. So if the S&P 500 is up 10%, then you're a stock picker. Your goal is to go up 12%. And if you outperform the index, you get paid. You get paid your bonus or whatever it is. Meanwhile, if the market is down 50% and you're down 45%, you get paid as well. You outperformed. So it's this relative perspective. Like I'd be upset because I lost 45% of my money. But it's all like this relative, you're always looking through a relative framework. And I think that's why a lot of these other concepts and thoughts aren't really thought about. Because you're saying like everything that we're investing in is denominated in these currencies. And if they're all devaluing, it's all relative. So it doesn't really matter. They offset.
To transition this sum to the Bitcoin value proposition, which I'm confident based on reading your work, you agree is very, very strong. We've sort of established that the macro backdrop is potentially ripe, which we can't hit on again. Like we're seeing the failure of the unit of account currently. And that's another comment I guess we could make on the DXY that I think we would be remiss not to identify is like, where are people flocking during these credit crunches and liquidity crises, right? They're flocking to the unit of account, which is internationally the US dollar currently. That's going to continue to happen as money supply expands, as debasement and inflation run rampant. We're going to have boomerangs back the other way. That's just how these events happen. The DXY is going to have periods where it strengthens, the dollar strengthens. It's momentarily confusing, but if you zoom out on a 10-year timeline, it's really obvious, right?
Mm-hmm.
Yes.
So we've kind of established dollar's going to devalue, rock in a hard place. There's nowhere to go for money supply but up on the long term, which is a massive billboard for Bitcoin.
Correct.
The other part of your work, though, that really stands out to me is the significance of developments on the network itself. And for people that are newer to Bitcoin, like if you're a 2020, 2021 entrant, even for people like us going back to 2017, there were still elements that could be hard to visualize for Bitcoin's trajectory. Like how is the network going to scale? Where's the application layer going to come from? How are we going to onboard transaction volume? Your work, one of the parts that really stood out to me was how bullish you are on Lightning and kind of how you characterize the application layer of Bitcoin. Feel free to comment on anything I covered, but I really want to pick your brain some about the significance of the Lightning Network for a variety of different reasons and applications.
Yeah, so maybe like before I get there specifically, I think it's really interesting since we were just talking about like stocks and things like that and other assets. One thing that I tried to present in that presentation was for the asset managers to understand the impact of what the Bitcoin network will have on existing business models and what the asset will have on existing valuations. Because I think that'll tie nicely into the what's getting built on Bitcoin right now. So just to take a step back, there are two Bitcoins, which most people don't understand. Okay, you have a Bitcoin with a big B, which is the monetary network. So the parallel would be like the Federal Reserve System. Then Bitcoin with a little b, which is what you see on TV, BTC. That's the currency that runs on top of the monetary network. So that's like the US dollar on top of the Federal Reserve System. It's Bitcoin currency on top of the monetary network. And existing companies incorporating the Bitcoin network into their existing businesses or the creation of new businesses I think it's going to disrupt every single business model out there. So if you think about like as a stock investor, you care about two things. You care about the earnings, the future earnings of a company. And then you can either use like a valuation multiple or a discount rate to discount back those cash flows. The same thing. So if you first think about the business itself, it's going to disrupt every single business. Then the earnings are going to decline for every business that's out there. And then because those are lower earnings, and they may even be more volatile earnings, the amount that you're willing to pay, the valuation that you're willing to ascribe to that set of earnings or that series of cash flows is also going to be lower. So the impact that Bitcoin, the network, has on the network itself, has on the existing business models and the valuations of other asset classes is tremendous. On top of that, you think about Bitcoin, the currency. It is by definition, in my opinion, the best form of money that there has ever existed. And as a result of that, what I was, other asset classes that I was using for a store of value, now I have a better alternative to transfer some of that money. So now you have, not only a lower valuation on these companies because of the business models changing, but then you also just have this flow of capital that's leaving assets that were literally just being used for their store of value qualities, which is like stocks over the last few years, in my opinion, goes into a new asset class. So I think that's extremely important because even if you think Bitcoin is like a scam and it's magic internet money, then you should at least understand the potential downside to your existing business.
I think that's a huge point too. And it's a good thing for people in general, because when people are speculating or trying to store value in, say, commodities, it makes your, fuel for your, put in your car much more expensive for an unnecessary reason. If you're storing your value in a monetary asset like Bitcoin, you're not pumping the price of all these commodities that we all need and, punishing the poorest among us because they simply can't afford these things.
Yeah. What you've described is totally different than how most of these individuals would be thinking through risk. When you say risk in Bitcoin, the immediate thought is, the risk that Bitcoin's buying power is going down. What you're suggesting is that as a superior monetary network, as the best form of money our species has ever had, this has the potential to call the bluff on and siphon out value from a host of other asset classes. And this is some of the game theory of the hedge position. Because as people recognize this potential reality, they're going to be like, just in case that were to happen, I need a little bit. And then the snowball rolls downhill. But that's when we've used risk in two very dissimilar ways, both of which need to be considered for asset managers.
Couldn't agree more. Well said.
Ryan, I'm just curious because you said as this transition happens, a lot of companies are going to have lower earnings. I guess I'm not following just because I totally understand, like, say, Visa, MasterCard, those are some obvious ones that are just going to get pummeled by this. But when you're talking about some regular like insurance company or, something like Warren Buffett's holdings, why would their earnings be diminished because of a change in numeraire or what they're using as a measuring stick?
Yeah, so I always really liked Warren Buffett, but I've chosen not to really pay attention to him on any of his thoughts on Bitcoin. I think it's
don't blame you.
One thing that's worth mentioning about Warren specifically, I think it's like just under 25% of his holdings at Berkshire Hathaway, their equity holdings, consist of like banks, credit cards.
Yep.
So you're talking like Ally Financial, Citibank, Bank of New York Mellon, Bank of America, MasterCard, Visa, right? So he is not incentivized to talk up Bitcoin.
Not one bit.
All right. So I mean, if you think about, I think that the simplest example that people have used, and then I also used, is, I mean, if you think about the transfer of payments to anyone, anywhere, that is almost in every single business, and there are fees taken along the way.
Mm-hmm.
So if you think about, I go to Walmart, I spend $100. Because of credit card fees, Walmart receives $97. Now, there are a few other parties between us. There is the bank issuer of the credit card. There's the merchant acquirer, which deals with the Walmart. Then there's the network provider, so like the Visa, MasterCard. They all take their cut. So, I mean, starting in just, I don't know, sometime this year with Stripe's partnership, with NCR, I was at Whole Foods the other day. I was at Walmart the other day. NCR is right there in the glass. If they want, they'll have the capabilities for me, instead of, scanning my Visa, MasterCard, or pay with Lightning. And I can pay with Lightning and they get the full $100. So I guess, so a lot of people say like, well, they're not going to go right to Lightning because Visa and MasterCard will do something to try to, stay relevant, which I agree with. Like, we're not going to go to a Bitcoin standard overnight. Okay. And this isn't even talking about Bitcoin. This is just talking about using the monetary network itself.
Right.
But now the POS has a competitor. And if the credit card companies want to stay relevant, then they're going to have to offer more attractive pricing to Walmart or all of the other merchants that they're using. So maybe they churn their margin a little bit, so Walmart and any other retailer can make a little bit more money. So you start seeing like the margin compression across all of these businesses. So just to make, like, again, to zoom out and take an extreme view, like I said, there's 3 different parties in here, but just assume that's like one company. Okay. Yeah. If I was the Walmart, for example, and my revenue is $100 and I'm making $10 in profit, all of a sudden there's $3 of opportunity here.
Mm-hmm.
Right? So all of a sudden, if I could, taken to extreme, just so you can fully understand that, put this in a bucket. If I can save $3 of every 100, my profit can go from $10 to $13. Right? My margins go from 10% to 13%, but my profitability goes up by 30% in absolute dollar terms. So the reason why I bring this up is because if Walmart could increase their profitability by 30% across the board for any like in-store sales or even sales that are getting done on the internet, then that is a huge profit pool that they can go after. And that is similar for every single business out there, whether it be Starbucks, I mean, you name it. And they're all in El Salvador right now, like actually deploying this. So like the companies know how to do it. So it's only a matter of time.
And you think about them right now getting squeezed by inflation, and there's this low hanging fruit, 3% right there.
And that's one way you can go back to the consumer. And essentially you're taking that, instead of passing that higher cost on to the consumer because of inflation, you can make those intermediaries take that.
Mm-hmm.
Yeah.
Right? So it squeezes them versus anyone else. So it's in the consumer's best interest and it's in Walmart's best interest. And they're the ones that are truly aligned in this whole dynamic.
We've been talking about this dynamic quite a bit on this show recently, the network implications. I don't think it's setting in for a lot of people that the tech is ready. It's all about users, right? The tech is ready or close to ready. And it's only a matter of time for consumers and merchants to realize that it's a win-win, which does get us back to the significance of Lightning. And it's one of my favorite parts of your piece, which is as layers are built on top of technologies, this is when they go exponential. So we know what Bitcoin is at the base layer. If you've been in for any period of time, you understand it's immutable, censorship resistant, monetary policy, right? It's basically the new global Fed that nobody can alter the rules with, right? We understand that. But as technologies are built on top of it, and as the layers grow and the incentives align for users to onboard, this is when we really get up and to the right on this adoption S-curve.
Yep.
Explore that for us, how that parallels other technologies that have gone exponential. I know you talked about the internet, electricity, stuff like that.
Yeah, so I remember I watched a video of Jeff Bezos. It was probably, I don't know what year it was, 2000s, 1990s.
I know exactly the one you're talking about. Yep.
Yeah, so I watched that, and that's where I kind of like thought to put this together. And more or less, it makes the case for, number one, you can't see, without a base technology, you don't know anything else that's going to be built on top of it. So for example, electricity was first laid out, and it's obviously very difficult to lay out like electricity. You're digging and you're going all over the country. So it takes a while. It takes a while for there to be adoption. Now, once that's laid out, there are two things that happen. Number one, people think of ideas to build on top of it. So like the air conditioner, the refrigerator. And because you already have that infrastructure in place, the adoption of that new technology is faster. You already have the line into your house, your lights are on. Now I need someone to just put in an outlet, splice into the line or whatever they do, so you can plug in the refrigerator. So what you typically see as you have these new technologies that build on another one, the growth of that technology increases, that subsequent technology increases. So that's I think that's more or less what Bezos was talking about in that video. So if you think about, and this is where it kind of comes to Bitcoin, you think of like the landline. Landline was similar with electricity. It takes a long time to put a landline out. Once the landline's out, you can run the internet on that, and you see growth in the internet outpace the growth of that initial landline. You can always make upgrades to the landline as well, but you see again similar growth or increasing growth on top. And then now you have the internet, and you think about other things that were built on the internet. So you think about like apps, you think about social media. Like all of a sudden you see these rapid growth rates. We already know how to use the internet. Now it's just an application on top. Mm-hmm. So if you look back over time, this has just been the consistent trend. And if you look at Bitcoin as the monetary layer of the internet, but we've already passed like that social network phase. You're building on top of the internet, or Bitcoin is building on top of like the internet and the network piece, and you're seeing the fastest growth we've seen of any of these technologies so far. So if you look at existing S-curve adoptions, and the math I more or less did was I took like the average S-curve and just made some, more or less conservative assumptions. And what that will lead you to conclude is that by 2029, the adoption and this is all based on US statistics, like based on the penetration, how many people in the US own Bitcoin. By 2029, either like 80 or 85%, I don't have the exact figure, will own Bitcoin, just based on historical adoption trends. And that is where it gets really exciting, because if everyone owns Bitcoin, then as more people own it, there will be a lot more use of the currency and the monetary network, which is going to drive more applications on top. And I'm seeing that more or less firsthand here in Austin, and that's one of the main reasons why I came down here in the first place. So if you think about the existing system, you name the service, it's more or less being rebuilt, removing the existing rails and using the monetary network of Bitcoin to recreate a new business. And I think what you're going to see is over time, every business that you can think of, if they don't make their own transition, it'll just get rebuilt on the Bitcoin network, and it will be a faster, cheaper, and easier way to kind of do anything in life, just like the email was compared to, sending a letter through the postal service. And I think it's just a matter of time. Once you experience it, that's when you'll really understand that it's not necessary. You don't need it, but it makes life a lot better. And that's what innovation does.
What are some examples of these applications on top of Bitcoin? And I think most of the examples would be on top of Lightning, just for anyone that's confused. Like, what sorts of things can be built on Bitcoin that may have been hard to visualize, say 3-5 years ago?
So some of the most, the ones that are most talked about is, for example, Strike. So Strike is a company that uses the Bitcoin monetary network to send money from peer to peer. So essentially what you can do is a person in the United States, if I could send money through Bank of America, through their Zelle network, or I could wire it and it would get to the other person, maybe same day, maybe next day, depending upon what service you pick. Strike, what they do is you can use the same dollars. You never see Bitcoin in this experience. Use the same dollars. I send $5 to someone else. It immediately gets converted to Bitcoin. Once it's in Bitcoin, it can use the Bitcoin monetary network, shoots over the monetary network like an email shoots over the internet, because Bitcoin is just a software that runs on the internet. And when it hits person X's bank account, converts right back to US dollars, it's in their account. So I sent $5, they got $5 instantaneously. They didn't understand that Bitcoin was being used under the hood. So that is the most simple way to think about it. But the other ways it's being used, there are other apps like SyncsChat, and there are these other video streaming applications where if you think about the legacy ad model, you are a product. You go on Facebook, you don't pay anything. You are a product. They're advertising to you. You go on YouTube, you watch 30 minutes of film, and you may see like 10 ads. So now there are other platforms that instead of monetizing the consumer's eyeballs and charging advertisers for those, they're just doing something peer-to-peer. So I open up a video through YouTube and I stream sats. I pay by minute or by second. So I may pay whatever I want, 10 sats per minute. So now all of a sudden you start thinking about I can support a podcaster. I can support a content creator, going directly to them. And that has two implications. Number one, you cut out the middleman, the Facebook, the Google, whoever it may be. But also you get better content, because it's not about just keeping someone on a web page for a long period of time. If you can stream and you only pay for the seconds that you're willing to stream for because the content's good, then the content creator is also going to be incentivized to create better content and more fuller content.
Yeah, and they're going to get better signal about what it is that people like as well.
Exactly. They can see when all of a sudden at some point in the video, the stats get cut off, and they can use that as their own AI, if you know what I mean, their own analysis to figure out what their viewers actually want to see. But I think that's just another model. But I think just if you look at almost every industry, I think again Bitcoin is going to have a role in it, because it so for another example would be the oil and gas industry, right? You have oil and gas companies that right now are paying a fee to flare off natural gas. It's a cost to them. Now they can cap that, runs an engine, fuels Bitcoin miners, and they can profit off that. So some people would say that is a bad use of electricity. But at the end of the day, it just makes the energy company, it improves the profitability of the energy company or the producer. So now that they can expand their operations, because before they were capital constrained. And in a country where we have, there are a lot of constraints on energy right now, that's something that we actually need. So that's just another example of where I think this is going to play a role. But, I think just with increased transparency across money in general, and less of, a few people controlling the money, the way money is used and spent will be put to better use. So there will be a proper allocation of capital, regardless of where it goes, versus the current misallocation of capital that we're currently seeing.
Before we let you go here, we have to ask the crowd pleaser. So you're saying network adoption, 85% based on some of these metrics you're seeing. And I think you mentioned in your piece that $140 trillion market cap is maybe not outside the purview of sanity, considering that it could eat up so much of the store of value from so many other markets, from housing, from real estate, from stocks, and on. Maybe even art. In the art world, people store tons of value. What do you speculate? Just throw a wild number out there for us. What are you thinking by 2029, 2030, if some of these things come to fruition? What would be a not insane number to speculate Bitcoin could be at?
Jeez. Let me try to answer that a different way. I'll give you a sense of where I think it could go, the timing of which I am not sure. Okay?
Fair enough.
So the way I presented it here, as I said, it's 140 trillion market cap. And what I did was I looked at each of the existing asset classes. Okay. And note, like I was presenting this to people like asset managers that already thought I was crazy. Right. So I had to be I had to be a little bit conservative with my numbers.
Yeah.
Okay. If I were to properly, if this mimics how I store my personal assets, then obviously adoption would be a lot higher and the price would be higher. But just to looking at this specifically, so I separated it between, debt. So you have corporate bonds, government bonds, other debt instruments, gold, you have the private, you also have public gold bullion, you have jewelry, you have industrial products, and then you have money supply, offshore, etc. Now, what I tried to do was, like, very objectively, what percentage of that do I think is actually being used as purely a store of value asset? Not because I could just put 100% and say, Bitcoin is infinity divided by 21 million, right? But I was trying to just, if I were to think about each one of these asset classes, what percentage of them do I think is actually being used for a store of value? So one good example is industrial products, gold. Like, that's a utility. There's a utility value there, right? Like, I don't think any of that is going to go into Bitcoin because I'm going to want my iPhone still or whatever else gold is going to be used for. Similarly, I think a low percentage of that, jewelry. I think some people wear jewelry because they like it, gold jewelry. So maybe some of that goes over into Bitcoin. But I try to just be very conservative with these numbers. And, from the total market that I think, the total market of all assets, this is not including derivatives, under my estimation is $600 trillion. So $600 trillion of assets out there. And based on, 15 different assumptions here, I came out with 23% of those assets are being used as a store of value. And that's how we get to $140 trillion, which equates to about $6.7 million per coin, per Bitcoin. Okay. And then that's also using 21 million Bitcoin. So again, being conservative. Then you can make the argument, well, 4 million of those are lost. Okay, 4 million are lost, then it's $8.2 million. But in order for the price to reflect that, you need that to be consensus. Everyone needs to believe it. Just throwing it out there.
Right.
So the $6.7 million in today's purchasing power, by the way, purchasing power.
That's a big deal to mention.
If the Fed prints
$6 billion in 5 years might not go too far.
Yeah, but I think if you were to take it to the extreme and said 100% of these assets went into Bitcoin, then the cap would be $29 trillion. If you assume that's using 21 million Bitcoins, if you assume that 4 million are lost, that gets you to a max of 35 million. So I've heard 100 million out there. Like, I can, if we keep printing for the next 100 years, then yes, it could be whatever you want. But under today's assumptions, today's purchasing power, that's where I think it could go over time. So I'll take a guess. So my guess would be, I think my 140 trillion is conservative. Maybe it's 10, 11 trillion dollars. It would be my guess. I think it should be higher, but there are utility value in assets, and people are gonna own their house because they can do whatever they want to it versus rent it. But
right.
I'm fine with that.
We're good with that number.
Yeah. Regardless of which way we spin this, sub 30K Bitcoin is extremely sexy.
Yes, it is.
I couldn't agree more. It's have a very, long time perspective on this, low time preference, DCA.
Don't leverage yourself, people.
Don't leverage yourself. The US dollar is programmed to devalue, and Bitcoin is programmed to appreciate in US dollar terms, right?
Yep.
Ryan, this was fantastic.
A lot of fun, guys.
Covered a lot.
Truly enjoyed it.
Appreciate your time. Give people a handoff.
Yeah. You can, if you want to contact me, you can find me on Twitter. It's Ryan_Deedy, Deedy. And that's probably the best place. It was a lot of fun talking with you guys.
Yeah, we enjoyed it.
Keep churning out the good work, my friend.
Will do.
Take care, Ryan.
Have a good one, guys.
Thanks so much for listening into the show. If you enjoyed this discussion, be sure to like or subscribe on whatever app you're using for podcasts or on YouTube. And if you have an extra minute, go ahead and leave us a review. We are also active on Twitter @blue_collar BTC. And our email address is bluecollarbitcoinpodcast@gmail.com. We invite questions, comments, or inquiries of any kind. We look forward to you joining us again on the BCB Podcast.